Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Hopefully everyone had a great Thanksgiving, and now we get to kick off with a little bit of a data dump on all the things that we missed because we didn't film last week, and we want to bring everyone up to speed. But we're going to do it fairly quickly, look at and then pull out the things that are important. What do we need to look at? What are some of the pieces that we're looking at in terms of where's inflation going? Because one of the things that, for those that have been following us, we've been very adamant that inflation was coming. It came with a vengeance, and now we're starting to see some slowdowns. And really, it's not so much inflation's going away. We're not going into deflation, but the pace of inflation is really giving way in December. And so far, what we're seeing in January and February, for the most part, but February is going to be a little difficult to really get a feel for right now. But one of the things that we're seeing is December, January, seeing that slow down. And then we're going to see this acceleration in most likely what we believe is going to be March and April. And then that will be the last push in that inflationary cycle. And then that's going to give way into stagflation. So we're already starting to see this inflationary movement. And you might think of, why is Powell so concerned right now? And one of the things that we've been talking about is this sticky versus flexible inflation. And one of the things that we've been talking about was that the flexible inflation was moving so aggressively, so rapidly, that you were going to get this it was going to pull that stickiness up. And a lot of these sticky inflationary figures were, once that starts, it doesn't really go away. Or it takes more time to go away. And that's why even as the flexible starts to get better, that stickiness is going to run. And that's where we continue to see some of these pressure points, which is why we see this inflationary pressure really giving way into stagflation as we start to see some of that pace not only flatten, but maybe even go down over the next 3 months before we get that last push. And the reason why we're going to get that last push is, again, because of wages and because of the labor that is needed, but also you have companies that have a record shortfall in inventories, which is something that we're going to talk about as well. So when we're going to break it up into our 5 segments, as always, we're going to have global rates and inflation, a U.S. data summary, and again, what it means, a U.S. holiday spending, what have we done so far on the holiday spending side? We were expecting October to be a very big month and November to slow. And so far, November really closed out, fairly weak as we head into December. And then we're going to look at the health of the consumer. Then we're going to turn to Europe, look at inflation and costs as both are now accelerating exponentially. And remember, Europe's a bit behind the US, so I think we're starting to see that really catch up. And then we're going to look at some of the most recent Chinese data, which some of it came in a little bit better than expected, but some of the leading indicators in that actually got worse. So we want to look at, where are we right now? Where are we going to be over the next 6 months? Because we think they're going to close out fairly weak, and then we could see a little bit of a bounce next year, especially because they're going to want to show some strength as they are hosting the Winter Olympics. And then we're going to look at some of the other Southeast Asian nations. So a lot of fun things to talk about. So we're going to dive right in now. And we want to look at, where is inflation at its highest. So inflation is a global issue. Argentina and Turkey are obviously seeing the worst of it. For those that have been following Erdogan talking about just maintaining the current low rates, and as he doesn't believe that that's an issue. And really, it's Japan that is the outlier with those levels. But you can just see how aggressive inflation is abroad. And that's one of the reasons why, when we look at timing, the U.S. still is a massive importer. And we're going to continue to import the inflation that is increasing in other areas. It's just, it won't be as aggressive because other pieces of the supply chain will improve. And those are some of the things that are getting a bit better. And we're starting to see some of this balancing act. So this is just giving you kind of a broad view of, where is inflation, where is it accelerating? And again, we're seeing it accelerate in Asia, in Latin America, and then obviously Europe as it starts to cool off in some other areas like China and the US. But again, the US is only going to be for a shorter period of time as some of these inflationary pressures kick back in for that one final push, which is really going to be in, let's call it, the end of Q1, most of Q2, until we start to really see stagflation really grip in Q3 into Q4. So then when we start looking at the reason why some of these policies are adjusting and why pressure is going to remain in that global market, is because we are seeing this policy tightening. We are seeing the economic surprise index getting worse, inflation surprise index getting worse for emerging markets. And this is why emerging markets are trying to get ahead of it, trying to protect themselves, because we are seeing this inflationary spiral. And while it's tough in other areas, emerging markets get hit the hardest because they have to rely on the US dollar. 85% of global trade is in dollars, and they have to try to balance their reserve currency. And the cost of their borrowing is going up exponentially because there's concern around their currencies, especially as the dollar remains fairly bid at about 96, which is fairly strong in comparison to some of these other currencies. And again, based on that, we're seeing the pressure points on the economic side. Their economies are worsening as inflation continues to surprise higher, which is why they're trying to get in front of it and bring inflation under control, which is what is leading to that tightening policy outside of obviously Turkey. And what does that mean? Well, funding costs go up because as you see inflation fears and the market says, look, I see inflation getting worse in your country, you're going to demand a higher rate in order to lend money to them. And this is just showing how funding costs have increased in recent months, and just giving an idea of which, again, Turkey, not a surprise, but then you look at Brazil, Russia, Mexico, and India is the one that we want to look at the most and really hone in on as inflation is starting that upswing. So they had some of that nice slowdown, but now they're going to close out the year really with inflation starting to run back up and accelerating, and that's where we think India costs are going to continue to rise, which is something that they're going to want to watch very closely, especially the RBI, as they're trying to manage some of their borrowings. And then South Korea, when you look at some of these countries, South Korea is really one of the only developed markets that is fairly high on this list. And the reason why is because they do have excessive amount of debt, and they have seen inflation really kick up. And the central bank has started to get in front of it. We've had 2 rate hikes, both of which were expected. Again, each one 25 basis points, so nothing crazy, bringing them to about 1%. But when we go in through segment 5, you're going to see how they have a lot of debt exposure, and they have a decent amount that's going to be rolling. So as that gets rolled, their costs are going to go up, which is, again, going to increase their debt expense, which is something that we think is going to start to pin down some of that growth. But with that being said, their imports and exports, especially exports, remain robust, but their PPI is going up, their inflation's going up, which is going to shake off in a country. And I think we can all guess which one it is, and that's right, it is the U.S. So when you look at who is kind of deemed ahead of the curve, behind the curve, obviously Turkey is behind the curve. I don't think anybody would disagree with that. But when you start looking at where things sit, India is the one that we always like to call out, because that is obviously a large part of emerging market growth, where a lot of this view of where that growth is going to come from. That's going to be one to watch as how are they going to adjust? Are they going to adjust some of their policies to make sure that they bring inflation under control? They've already taken some steps that we've highlighted. They've cut diesel and gasoline taxes. They've tried to alleviate some of these different pressures, but food, vegetable oils, other forms of oils, again, outside of just crude, are very difficult for them, especially on the food side. So that's where, and you are seeing import costs go up, and then those PPI just like everyone else, is also going higher, which is putting pressure on the consumer. So again, all of these things are why we're starting to see, again, we've already been in a rate rising cycle, but this is why we think it's going to accelerate as they try to adjust and protect on what is going to be a difficult Q1 and Q2. And then we're going to lead into this, again, this weird stagflation. And by weird, I mean, it's going to be something similar to the late 70s, early 80s, kind of based on what we're seeing, where there's going to be some deflationary pressures, but we think that the inflationary pressures are really going to offset and is going to keep us fairly sticky in this weird rut. And again, that's going to limit the amount of growth that we're going to see throughout 2022. So then when you look at the FX reserves, this is one of the things that we keep talking about of FX reserves, short-term external debt. Where do we sit right now? And when you look at where some of the comfort is, the Philippines have ample FX reserves, just to give you an idea of kind of where the reserves are and who's short. And you get an idea of, again, why India's elevated on this list. One of the things that we're concerned about, Turkey is obviously someone who is very short on this list, but India is fairly well positioned, and Indonesia is in a fairly comfortable area. Even though, and the reason why is there's a lot of trade that's still going through there. There's still a lot of movement that will naturally bring in dollars. So even though Indonesia is elevated, India's, let's call it, Indonesia's right in the center. India's on the top end. That's a positive to help control some of that inflation. But Turkey, this is where we start to get concerned for Spain, where Spanish banks have the most exposure to Turkey, which is where we could see some potential contagion go from one area to the other, which is why we do talk about Turkey as much as we do. But where's the financial cushion? So when you look at the financial stimulus provided, where is it really sitting, and real household income per capita? So clearly you've seen the U.S. has been elevated. We've seen a lot of money get passed through government transfers in total. OECD countries have stimulated aggressively. We've seen a lot of stimulus come through. But the real GDP per capita, when you think about the real household income and then what that has done on the real GDP side, you can see just where some of the struggles are when we're looking at how these different impacts of inflation will come in, how we're going to see that spending start to pare back, which is what we've started to see into December, and we think it will remain in December. And then given January is already a soft month, we think it's just going to be that much softer as we go into, and we've already seen savings come back below back into 2019 levels, which we've already ripped through all of the excess savings that we had built up through 2020. And then as that inflation doesn't really go away, but just goes steady, sees another increase, and then goes into the stagflation, that's where you're going to see this. Where do wages come in? Do wages keep pace? And again, it's not just a U.S. phenomena. It's something that is impacting other regions, and you can see the slowdown, which is why Germany, other European countries are so far behind, where they're starting or trying to come up that curve, and that's where we see the next push on the inflation side. But as we keep talking about inflation, some things are getting better, which is the supply chain. And again, you're just looking at longer delivery times. And one of the things that we've been talking about is they're just going to stop going up. You're going to see them stop going up. They're going to start coming down a bit and then kind of bumping sideways as they drift lower. You're not going to see this huge reversion down, but more of this kind of stable drift as things normalize. But when you look at output prices, input prices, that's going to be some of the key components of where are those prices going. And when you look at the Eurozone, output prices are going up, input prices actually triggered back higher again. And that's where the U.S. is starting to slow. You're starting to see that, again, that leveling off, but you're starting to see that acceleration in the Eurozone again. You're seeing it in Asia. And those are things that will come back to the U.S. and offset some of the benefits that we're seeing with shorter delivery times and things starting to normalize as we progress through not only Q1 but into Q2, and then really seeing what we think is going to be a more meaningful reduction in Q3 of next year. So November is the first month in which global delivery times looked less stretched. That's most noticeable for the US, where it is feeding into output prices. The rest of the world is running behind, and we still see some of that lagged upward pressure on output prices, as we've been saying. So then when you look at global net purchases, so all of this is happening as governments and, well, I should say central banks are going to purchase less government debt. So this is where you're going to get this slowdown, and then it's going to get pressured because you're also getting tapering coming through, which is why we do see that more extended drag as we go through Q2 and Q3 of 2022, and we see a lot of this slowdown, which is why I think the growth estimates remain a bit elevated for where we actually see things playing out. And that's going to be something to pay attention to as we go through into the new year. And then this is just showing what the Fed has done. The Fed funded most acute COVID debt issuance. But a lot of these all of this debt that was issued was purchased by the Fed, but it has to get rolled. And it's going to continue to get rolled because we're always rolling debt. We're always issuing new debt. We're more than 50% funded by debt, especially on the new budget. So as the Fed goes away, it means we're going to have to rely more on a natural market, which is who is going to replace them as the biggest buyer. As you can see, the Fed going away. We do expect some foreign buying to come back in because rates should drift up because of this. And that will entice some additional purchases. Instead of just coming out and purchasing dollars, they'll come out and buy additional debt, and that will bring in some new cash, because not only are you going to get your principal, but you'll still get interest and increase some of that capacity. And the share of U.S. adults expecting food prices to increase in the next 12 months, you're going to be surprised to see that everybody expects it to go up. And it's just how often you go to the store, how much do you rely on spending. So clearly, this is just showing where some of that pressure is coming in and why people are concerned, because we are going to talk about University of Michigan consumer confidence. And that is going to continue, that's going to be a big driver on why people feel a bit concerned about the future. And the reason why we talk about the U.S. here is because the U.S. can feed itself. So if the U.S., if consumer and what we see happening right now is concerned about where food prices are going to be, that means that that's going to trickle down and really impact how things are in the world are also going to be impacted over that time period. And this is just looking at the Bloomberg Agriculture Subindex. That continues to move up. It's balanced out a bit. It's gone a bit sideways. But again, when you look at UN Food and Agriculture, all of these things are just showing that. Not so much that they're going to continue driving higher, because I don't know if they're going to continue going up to the same way, but you're going to start to see the UN Food and Agriculture start to go sideways a bit. And I think you're going to see some of this pressure continue to move through as there are shortages. We keep seeing tenders reissued. We keep seeing a lot of these, these pieces impacting what is happening in the world today. And food prices are already near record levels, while agriculture commodities haven't even had their big move. Still 35% from their prior highs. So there's still more room for food prices to rise from here. But at the same time, some of that will be offset because we'll have dry bulk prices have come down a bit. You're starting to see some of those costs mitigating, but there's still agriculture expense input prices, seed, fertilizers, all of that has gone to new all-time highs, and that will continue to come through, especially as we look into 2022, which is why we keep talking about some of these pressure points as some of that inflationary pressure in next year as well. And net exports continued to move up. When we look at wheat, we look at corn, the actuals came in on above the top end of the estimates, where soybeans came in right in line. Mexico and Canada were the top buyers of U.S. corn, and China bought 883,000 tons of soybeans, including 461,000 that was switched from unknown. So again, that was already spoken for, but now we know where it's going. And Japan and Nigeria led in wheat buying. So here you're seeing, again, pulling more into the open market, which is keeping our prices bid as they continue to try to go into the market and get the best price. But so far, after a huge rout in crude prices, as we talked about in the EIA show, you started to see some of the commodity index come down a bit. I think it's important to zoom out and look at where some of these things are, where some of the different prices. We're just back to the highs that we had in the middle of the year. And again, I just think that we're going to see, and there's a lot of comfort in this range as we close out the year and head into Q1. But all of these different pieces, when you look at global manufacturing, we're just below 55. We still have some fairly strong manufacturing in the world. There's still, broad shortfalls when we look at inventories, empty shelves. A lot of some of that is going to come through. And again, that buying, that refill of inventories is going to help keep this fairly fixed. But again, that's also going to keep prices a bit elevated because nobody's looking to lock in prices now. They want to try to manage their inventory, let prices come down a bit, which we'll start to see in December, January, February, and that will increase some of that buying, which again is going to keep this fairly bid. As we see, what are people buying? Consumer, intermediate investment. And here you can see things are really starting to kind of come down. And we do think this trends lower, but still at an expansionary point. It's just we do see some of the impacts that we're seeing from raising rates, slowing economies abroad, and that's going to mitigate some of this increase and again, kind of slow this down a touch. But we are starting to see some adjustment in flows where Port of Long Beach containers loaded 12-month rolling sum. You can see the inbound still at a record, outbound fairly flat. And that's where we're seeing some of that disconnect because as the inbound comes through, there's that delay of getting what came into the system, came into our market back out. And again, that's where the supply chain continues and to get delayed. And while it may get better, it's not fixed and it won't be fixed for full quarters. It could be all of 2022 at this point. We just think that some of the biggest reductions in issues appear more in Q3 than in the first half of the year. And this is what we were talking about with some of the supply pressures continuing to get to improve slightly. When you look at the Baltic Dry Index, that has started to come down. We're back to where we were at the beginning of the year. Then when you look at China to U.S. West to China to the West Coast, starting to see that come back to before we saw that big spike in June. Then you look at the global. We're starting to balance out. And again, it's not so much that we're going to see this massive improvement. It's just the peak is in. And now you're starting to see some of this benefit whittle down, which will take some of the cost out. The cost of the goods in the containers is still going up. We're still seeing that price increase, but the container itself is getting cheaper to move, which again is some of that underlying benefit. And then, but there's still delays. And again, these are things that don't go away all that fast. Transit time to ship goods from ports in China to the LA has doubled. So it's doubled, but it's going to come down. It's going to come down slowly, just like it went up fairly slowly. And obviously you had some acceleration points, but it's not going to just turn around and be like, oh, yeah, we went from 65 to 35. We're fine. That's not how this works. There's backlogs. There's, you need labor, you need trucks, you need trains, you need things to be moving. And that's what's keeping things so struggling. Or you need people to just do an all stop on buying. And we all know that's not going to happen, especially in the US because we do like to spend money. And then this is where the backup waiting for berth, the number of ships waiting to enter the LA Long Beach port has skyrocketed. Here we're still at almost 75 ships as we continue to talk about in our EIA show every week in segment 2. Containers stuck on the docks. Here's just, again, containers unable to proceed through the system. And this is why they've tried to increase fines, try to incentivize people to accelerate these movements because you can see just how much is just sitting there on the docks, which then if there's a lot on the docks, that means that you're losing space. If you're losing space, you can't unload the new ship fast enough, and you can see how that snowballs on itself. And that's when you start looking at the ASEAN countries where we've had a nice recovery. We've had some of that those movements up. But as we've been saying, we believe the top is in for ASEAN countries, and you're going to start to see that drift closer to about 52 based on some of the metrics we're looking at. Again, you're not going to see it go into contractionary territory at this point. That's something that could happen again, or likely to happen in 2022. But you're going to see some of this, settle out a bit, but still remain in a growth trajectory. And this is just breaking it down, where you're seeing some countries have already gotten there, where you're starting to see them level off. Thailand, Vietnam. Vietnam is one of the ones that we're looking at some of the bellwethers. You had Malaysia, Indonesia come back strong, and again pulling back towards what we think is 52 is going to be where some of this kind of settles out as we go into the end of the year and into Q1. But when you start looking at worldwide non-cash transactions, this is going to be interesting because, again, we're shifting away from the paper moves. Everything is going more electronic. And this is where we start to see some of the opportunity in opening up, not so much with Bitcoin in general, but just cryptocurrencies overall and blockchain and some of the opportunities, because I think it's fair to say that we will see a growth. It's just going to be a matter of what is the pace of adoption, the pace of growth, and how much paper do you need? The running joke is, can we run out of green ink? Well, if you're not printing on paper, you can't really run out of green ink. You just keep adding zeros to the accounts without actually showing a change in physical dollars. And this is going to be something that can also help the movement, the stability of some of these countries by enabling some rapid shifts in just SWIFTs, Fed swap lines remaining open, but there's going to be ways to speed that up. How do you shorten the accounts receivable, accounts payable? And blockchain can do that. So I think this is something that's interesting when we look at the adoption of some of the other entities. And then when we start looking at inflation by region, so here's where we're looking at Europe continuing to rip up. When you look at the Middle East, North Africa, fairly stable, but Latin America, Europe is starting. And then the Asia Pacific, and that's where you look at that blue line, you see it's starting to creep up. And that's the one that we think, that blue line there is what we think is going to accelerate back up and result in additional slowdowns as we go into 2022. So then when we start looking at global energy investment, because this is something that I think is important and we really wanted to hone in on for a second. Because when you look at what is being invested in, energy infrastructure, again, we have a private equity fund. This is something that we're looking at. Energy infrastructure is where we're trying to hone in power gen, because we don't look at them as separate, but as the same thing. And we've already seen a litany of shortages around the world. And that's where I think that you're going to see additional money coming into to try to protect and create some redundancy in the system. And the global energy supply investment. Upstream has seen some slowdowns, but 2021 saw this shift back up. And we're already starting to see additional commentary on renewed CapEx coming into some of the upstream space, which is where we expect to see 2022 even above where we were in 2021. But the renewable power is starting to level off. And I think the electricity network and nuclear is where we're going to see some of that focus, some of that new dollars going into, because we need transmission lines. We need more transmission. We need more networking on the electricity side. Smart grids can be deployed. There's going to be some of these different pieces that are going to be baked in to try to help solidify some of these shortfalls. And again, nuclear going to be, I think, a bell of the ball soon after seeing a lot of that demand dwindle down. And then when we look at global investment in the power sector, again, the renewable side is flattened off a bit, but the nuclear and electricity networks is the one that we think is going to continue to see some of that favor. And then when you look at the investment in grids by geography. So as we look at the U.S. I think is going to pick back up. China's already been in a fairly sizable way, but distribution and transmission is going to continue to grind higher. We're asking the grid to do more. We're increasing demand, so we need more transmission. We need more distribution, and that's why grids will see additional investment in 2022. One of the things that have gotten some level of investment is the grid scale battery storage. And this is where the technology isn't there. And clearly they're investing in that technology. They're trying to solve some of these problems. And the behind the meter battery storage, which is on the local level, or the residential level versus grid scale, it's still in its infancy. We're not huge believers in large scale battery storage. There's a lot of issues in terms of, the ESG score if we want to do cradle to grave, in terms of making and sustaining these batteries. So these are going to be some key points that we're going to look at. And as we progress through 2022, we're going to look at where is the technology, how are things growing, and does behind the meter battery storage make a bit more sense versus grid? So again, these are going to be interesting things to look at globally speaking, because you can see where the investment is. The US, Europe, and obviously China are going to become some bigger focal points as we head into 2022, especially when we look at rare earths and the geopolitical issues that we face between the US and China.